Good morning, everybody. This is Live Trading Talk with Patrick MontesDeOca for March 15th, 2022. We're taking a look at the headlines right now in the Associated Press. And beside the Russian invasion, what we're looking at is a headline with regards to China, and basically it appears that Russia has asked China for military aid. How plausible is Chinese military aid for Russia? So the geopolitical conflict here is beginning to expand, you might say, and getting China involved, as China is under a lockdown as a consequence of a new COVID pandemic or infection that's going on, that they have been forced to shut down one of the major cities, and potentially the ports are in jeopardy as well. So we are continuing to see additional supply chain constraints, supply chain pressure building up into our inflationary numbers that are running pretty high. The economic numbers that came out this morning were indicating basically that inflation is running at about 10% year over year. And if we get involved with China and Russia with regards to supply issues, the Western world could experience a severe impact in food supplies, energy supplies. So we seem to be tampering with some very, very serious issues that could affect severely the Western economy, a lot more than already it has as a consequence of this pandemic. This could just exacerbate the situation and prolong the disruption in the supply chain a lot longer than expected. We're expecting the Feds to come in today and basically establish monetary policy with regards to the current inflation levels that we have. And the expectation is that we're going to see about a 1/4 point increase. This is what was mentioned in our last meeting with Chairman Powell, that a 1/4 point, I believe, is baked in the cake, so to speak. The surprises will be anything higher than a 1/4 point. I think the market is beginning to price in about 25 basis points. One of the indicators that we're watching here basically is the yield curve, the difference between the 2-year note and the 10-year note, as the yield curve is basically beginning to invert. And that basically means that interest rates, the pressure of interest rates short term, is rising faster than the longer rates, than the 30-year bond. And one of the things that is clear to see basically is that this spread relationship, particularly between the 2 and the 10-year note, When they get inverted, it usually indicates the sign of a recession is to follow a few months later. So we have an unusual situation here that is unfolding. The supply chain is getting a lot worse, basically, and potentially, again, it could have a serious impact on the global state of particularly food. If we get some kind of embargo or shortage in food supplies coming out of the region from Russia and China, it could really change the dynamics of pricing, you might say, for commodities, in particular for grains. And in particular, as we begin to see a shortage of supplies, the U.S. is experiencing weather supplies, a severe drought. South America, Argentina, Brazil also experiencing basically weather problems, and also a reduction in the crops. The estimates are declining on top of a potential shortage of food supplies. But we're getting into a situation where we're finding ourselves with a shortage of just about everything. Nickel, wheat, corn. Ukraine, or that area, is responsible for about 30% of world production in grains. It's the second largest natural gas producer in the world, with crude oil reserves that basically established them as the second largest. And this is in the Sea of Oz, which is the area that is being in conflict right now with Russia for obvious reasons. This war is about crude oil and natural gas. It's about taking control of the energy markets, while the U.S. is involved in this rhetoric about green energy, and there is nothing that can replace crude oil as of yet. There is no source of energy that can replace crude oil, or coal for that matter. So unfortunately, although politically we're moving into this green economy, so to speak, it is a pipe dream, because nothing really can substitute crude oil that went from a negative $37 a barrel within 2 years to $130.50. And so this is what this whole thing is about. It's the control of crude oil, natural gas on a global scale. What really is kind of confusing is that the U.S. is asking Iran, is asking Venezuela, is asking the Saudis for help to reduce, or to increase, you might say, production, to reduce possibly the inflationary consequences that we have as the price of oil trades above $100 a barrel. It is a major deterrent, a major, I would say, impact. It will have a major impact on the world economy. It's a big tax on everybody. And so it begins to sound almost like the 1970s, when we had the oil embargo. And you saw what happened to inflation then, and you saw what happened to gas prices then, gasoline prices. The average gallon of gas, I believe, is at about $4.25 in the U.S. In some areas, particularly where I live in California, we're looking at about $7 a gallon. And this is the sacrifice that President Biden is justifying this issue that is building potentially to be of a serious consequence economically. The invasion of Russia is disrupting the global economic system. Sanctions are collapsing the Russian economy, and potentially China may get involved. It's not going to help anybody if the world economy collapses. If we have conflict with China and Russia, not only politically but economically. So there is a lot of volatility that we're facing as this situation unfolds, basically in front of our eyes. And what I'm trying to do here as a trader basically is see where the opportunities lie, how I can take advantage of this volatility, and also for the benefit of myself and my subscribers, my traders. This is a historic situation, and there are historic opportunities that are developing, that are unfolding. Let's take a look at the market here for a little bit. We see gold breaking down to 1916, 1917. It's trading below the daily average, the daily buy to level of 1924. Down $44. Silver is holding steady at $24.90 at the buy one level daily of $24.85. The extreme below the mean, or the standard deviation of silver right now, is a 1-to-1 factor from the buy one level of $24.85. And the expectation of the algorithm is that a reversion should unfold, as it did here, but it did not follow through, activating another trigger, another setup here at $24.85. A close about $24.85 using the 15-minute bar will activate a buy trigger. If it doesn't give you a buy trigger, do not go short, as the market is entering what appears to be a level of support, a major level of support. The area in blue is considered to be accumulation of supply. This is where the algorithm tells you to accumulate supply. So what we have seen here basically is the price of gold and the price of silver have come down after making a high of 2,078 on the news of the Russian invasion that took place on March the 8th. That's about 7 days ago. And we looked at this as, once again, area of distribution of supply, and potentially the market will revert as it did, coming back down to what appears now to be an oversold condition. What we want to see here is the market revert from these levels as it has the potential to come down all the way to the buy to level of 1892, which will be a standard deviation 2-to-1 factor with about a 95% probability of a reversion unfolding. So what we want to do is keep an eye on basically the demand that we see here, the support that we're finding here, and to trade alongside a close above 1924 would activate a buy trigger. It appears that the metals have come down to an extreme level below the mean or standard deviation. And we're at the extreme below the mean. And so as we consolidate down here, the probabilities are very, very high that we should see buyers come in at these levels. And in silver, 24.85 is a major level of support, but we have a buy to level all the way down to 24.44 on a daily basis, with a weekly at 24.36, and that's a very high probability harmonic relationship of standard deviation between the daily and the weekly. If the market has enough supply, these are the levels that would be ideal buying opportunities. Bitcoin is very quiet here. It's consolidating around the daily average of 38,502 and the weekly average of 39,577. So it's neutral. And let's see how it resolves here during the rest of the week here, but it's a neutral. It's been in a neutral position here since last Tuesday. And this is building support here at this level. So let's just allow for the market to consolidate and build the support that it needs to build a foundation for much higher prices to be accomplished. One of the things I would like to do here on this part of the segment is to give you a strategy that I'm following here, which is basically working out very well. On January 15th, for our private subscribers in Seeking Alpha, we published a report basically that is about silver and the stock that we're using to take advantage of the silver market on a diversified basis. The name of the report was Silver, Load Up the Truck with Hecla Mining. For silver, we trade Hecla Mining. It is potentially an explosive stock. We are recommending to our subscribers to build a position in Hecla. Hecla produces nearly half of the U.S. silver. It is operating North American mines and several pre-development projects for precious and base metals. It is the oldest precious metals mining company in North America listed on the New York Stock Exchange. We recommend buying and holding Hecla. Hecla was trading roughly at about 508 when we made this recommendation. And what we saw here was the stock run up to a high of 766, almost meeting the target that was expected. And what we saw was a little bit of a reversion unfolding here by bringing basically the price down to its standard deviation below the mean into a level of support. And a buying opportunity. When we published the report here, Hecla was trading roughly at about the low $5 a bushel. We ran up rather quickly to about $5.85, $6 a bushel, and then came back down to make a new low of $4.58. And that was it. That was the low. The market reverted from here and ran out to making a high of 766 on this initial leg. This initial leg is the first leg of a major move up in Hecla. And what we have seen here is simply a little bit of profit taken and a correction into an area of support. Once again, that identifies the algorithm as an area where you want to accumulate supply. You want to buy inventory. You want to add to your Hecla positions. And basically, this is a stock that we are taking advantage in terms of the potential shortage that is building up that could potentially affect the silver market, the gold market as well. I don't believe we have seen yet the full effect of this supply constraint in precious metals as of yet. And I'm focusing a great part of my portfolio in this particular stock, as essentially what we're buying is an undervalued gold mining company, silver mining company primarily. This is a solid company that you want to hold on, and you want to build and buy into any corrections given the opportunity to do so. This is a buy and hold as we trade the futures markets in gold, silver, and Bitcoin for short-term trading opportunities. So far, we have a fairly quiet market here this morning, considering the China potentially issue can unfold more seriously. Particularly if we get into a confrontation with China as it regards to Russia. It is my conviction that the prices of precious metals, gold and silver, still have not yet fully recovered to its real mean based on this latest fundamentals, based on interest rates, based on the world debt that we're dealing, and particularly based on the inflation levels that we're running. We will keep the live trading room open for the remainder of the day. If for those that would like to come and see what we do live, please like and subscribe. Let us know. We'd be more than glad to send you a trial. In the meantime, my friends, have a great trading day for the rest of the day. Be safe. I'll talk to you later during the market wrap.